right, close enough. My watch says 11:02. Let's go ahead and get started. Welcome, everybody. It's good to see everyone. We're joined by a lot of our clients and trusted advisors this morning, so thank you for joining us. See a couple of new folks on the call as well, so welcome. Before we get started, as usual, I'd like to cover just a couple of housekeeping items. The information we share today, just keep in mind, this is intended to be educational in nature and not to be considered official financial or investment advice. I know there will be some questions that come away from the content today, so I just ask you that if you have them come up, just write them down and we'll give you an opportunity as a way to kind of get those questions over to us so we can make sure we get them answered for you. One final thing, it's just important to note that although Granite Harbor Advisors and Husch Blackwell work very closely with one another on a lot of families' cases, we are officially separate entities. So first, let me go ahead and get started. I'll introduce everybody on the call. My name's Brian Sack. I'm one of the managing partners at Granite Harbor Advisors. And at Granite Harbor, we have a very simple goal. Our goal is to help families live their best life possible. We've got a lot of experience in helping individuals and families navigate financial challenges that life brings. And we help them navigate difficult decisions associated with owning businesses, transitioning into retirement, legacy planning, which we'll focus quite a bit on this call today, and more. We do this through comprehensive financial planning. We serve as the family's CFO in many cases, helping to organize the information so you, the family CEO, can make informed decisions. We help our clients manage assets as well as the selection and implementation of appropriate insurance solutions. Today, I'm also joined by my good friends, Ben Kelly and Amy Kuntz at Husch Blackwell. Together, we collaborate on many families' behalf to ensure all the key estate planning issues and estate planning concerns are effectively addressed. So without further ado, I'm going to turn it over to my good friends, Ben and Amy, to get us kicked off. Guys?
Thanks, Brian. Thanks for having us. Thanks for everyone for coming in. I know when I say Thursday morning, mid-March, what do I think of? Death and taxes. So I'm super excited for you guys to be here. So we want to kick this off. It's going to be more of a conversation between the three of us. We're really trying to make this more engaging versus a lecture. And when Brian and Amy and I were thinking about this, really, estate planning can mean so many things. But as Brian alluded to in the mission statement at Granite Harbor, and I think Amy and I think the exact same thing, which is our job is to help families. And the toolbox that we happen to play with is one that's in the estate planning space, taxes, wills, trusts, et cetera, et cetera. But at the end of the day, the crux is simply helping families. Because when you have young children, you're trying to explain what you do for a living. You can't really tell them you deal with when people die, because a 6-year-old freaks out when you tell them that. So I realized, my goal every day when I go to bed is, did I help a family? And with that vein, we're going to kind of go through what is estate planning to us at Husch. And as we talk to Brian and Nick and Tim and their clients and our mutual clients, this is kind of our approach and how we think about estate planning. So Amy, maybe you can kind of give us a flavor for how we view the world of what is estate planning, but, in the context of helping families.
Sure, absolutely. And again, thank you for having us. Thank you for everyone joining. So when we talk about estate planning, it is no more complicated than answering 3 questions. The first question is, where does your stuff go? So your stuff, your assets, where are your assets going to go when you pass away? The second question is, what are the rules? So in other words, are there strings attached to those assets? What are the rules for your assets that you're passing at death? And then finally, who is in charge? So who is going to be your representative for transferring your stuff where it needs to go? So we'll talk about each one of these 3 things in a little bit more detail, but we've found, in our practice, like Ben said, we deal with death and taxes every single day. That can make people a little uncomfortable, not just 6-year-olds, when you're talking about, death and where your stuff goes. So to make it less overwhelming, we try to boil it down to these 3 questions. We start every single conversation with our clients reviewing these things. Where does your stuff go? What are the rules? And who is in charge? So let's talk a little bit about the first question. Where does your stuff go? So it's really simple. There's only 3 places where your assets can go. family, charity, or IRS. And I'm willing to bet that Ben and Brian have the same experience as I do, that most clients are super fired up about limiting that third party, that IRS.
Sure.
So we always, that's when we're looking at where your stuff goes, family, charity, IRS. And we're going to talk a little bit more about how the IRS gets involved when you're passing assets at death. The second question that we always answer when we're talking about estate planning is, what are the rules? So again, what are those strings that are attached to those assets that you're leaving at death? Some of the things we look at are those assets being left outright or in trust? So I have the option, if I am doing my personal estate planning, to leave assets to Ben and Brian individually, just in their individual names. They can do whatever they want with that. The other alternative is I can leave those assets in trust for Brian or Ben. Now, why does that matter? You know, when you're leaving assets in trust for a loved one, there are so many benefits that they can get with those assets that you've left in trust. So one is creditor protection. The second would be divorce protection. A divorcing spouse, those assets should be protected if they're held in a trust. And then finally, estate tax protection, which we'll talk about as well. Now, when it comes to flexibility, when we're reviewing documents, we're always looking to see, hey, have we built in flexibility? Now, there are all different ways that you can do this, where you can build in flexibility, but two of the things we look for are powers of appointment and trust protectors. And, you know, we really, really like flexibility. It helps families in the long run. So we always look for those things. When we're building those rules, Ben and I are big proponents of adding in that flexibility so we can make sure these documents work for you in the future.
And I think that flexibility is often overlooked, because estate planning is a little bit of a journey, not a destination. And Amy, I know you've had a long career. I've had a long career. Brian, you've had a long career. I don't have a single client where the rules haven't changed. Family dynamics haven't changed. Things happen. Tax laws change. Elections occur. And if you're not in a place where you've created a document that can live and breathe with the client, you're just not their advisor very long. So this one we take serious, as well as that protecting the children. Your children become our children. So those assets and trusts are really important. So
Right.
Amy, you just hit the nail on the head with this flexibility concept.
Yeah, for sure. I was just going to add in one other thing there. I mean, so many times you nailed it, Ben. Journey, not a destination. Estate planning is not a transaction, right? It is a process, and ensuring that we have that flexibility. So many people get in their minds that when I do my estate planning, it's permanent. It has this sense of permanence. And just as you mentioned, you know, legislation, tax law changes, family dynamic changes, all of those things, as long as they're carefully thought for and the appropriate flexibility in the terms are put in, we can kind of navigate much more effectively.
Yeah, definitely. It's important to be able to pivot. You know, like Ben said, if a client calls and says, hey, I want to change this, and you say, nope, can't do that. We're not going to be their advisors for very long.
Yeah.
So
Right.
we want to build in that flexibility when we can. So we're always looking, when we're setting those rules for our estate, let's try to be flexible, understand that things are going to change. The other thing that we give some thought to when we're setting up those rules is, what distribution standard do we want to use? So let's say that we are leaving assets in trust for our children. Now, remember, with every single trust, there's three people involved. There's the grantor, that's the person who creates the trust. There's the trustee, that's the person who manages the assets owned by the trust. And then there's the beneficiary, right? And that's who everyone wants to be. That's who the assets are held for the benefit of. So you can tell your trustee, hey, trustee, I want you to have full discretion. You can use these trust assets for my child however you would like, absolute discretion. Or you can limit the standard to something that we use called HEMS. HEMS stands for health, education, maintenance, and support. So again, when we're setting up these trusts for our children, other family members, we're always going to look at, what kind of discretion do you want to give to your trustee? Now, the next thing that we're going to answer when we're looking at rules is, who is in charge? So you can have a person, an individual be in charge, or you can have an institution be in charge. There's pros and cons to each, but we always want to give thought to, when we're doing our estate planning, who's going to be the best choice to help us get our assets where they need to go, manage our estate. The other thing that you do have the option of doing is, with a trustee, we typically see a trustee fill 3 different roles. There's an administrative function. That would be things like filing a tax return, any kind of notices that are required to beneficiaries. So there's an administrative function. There's an investment function. So your trustee is going to be making decisions on how those assets are invested, different things that we're going to, spend our money on. And then finally, there's a distribution function. So the distribution function is probably the most fun for a trustee, where they get to say, hey, here, beneficiary, have a distribution. So maybe you have someone that is better suited for the investment decisions, but you want to split up the administrative and distribution decisions from that. So you do have the flexibility to segregate those roles. And then finally, we always want to give some thought to, hey, do we want to name our children as their own trustees? And that's always a conversation where there's, several pros and cons. I always tell clients, hey, let's make Thanksgiving about Thanksgiving. Let's not make it that, Ben is my trustee. He didn't make that distribution to me for that Ferrari I really wanted. So, I try to tell clients there are some benefits to having your children serve as their own trustee for preserving family harmony. On the other hand, it could be a concern that there might be some sort of, divorcing spouse that would try to claim, make a claim against the trust if the child is in charge of the asset. So we weigh the different factors and we make an informed decision on who's going to be in charge.
And going back to your earlier point about flexibility, this role of trustee will evolve, over the journey of the estate plan. At one point in your life, it'll be X. The next point, it'll be Y. Something will happen, it'll be Z. So it's again, that flexibility, that constant review. And when I mean constant, I mean weekly, although we would love to talk to you weekly, every year, 2, 3, depending on the complexity. These things have to be resolved and reviewed and discussed, because you always come back to those 3 questions. Where's your stuff go? Who's in charge? What are the rules? And that flexibility that Amy talked about earlier is so critical to make sure that the plan lives and breathes and the right people are really in place to help you carry out your wishes.
For sure.
Yeah, definitely. So now I kind of want to jump to the transfer tax system and how the IRS gets involved. Remember, we said there are only 3 places where your assets can pass: family, charity, IRS. So how is the IRS involved here? So many people are very familiar with, everyone on this call, very familiar with the income tax system, right? We've got ordinary income, we've got capital gains, you've got payroll tax. Brian and his team did a great job of, providing us with an overview of what changes might be coming to the income tax system last time. But there's this other tax system out there called the transfer tax. And all it is we are taxed on the privilege of passing wealth to a loved one. Okay, so during life, it's a gift tax. At death, it's an estate tax. And it's a steep tax rate. It's 40%. I know, Ben, since you've been practicing, I believe it's reached as high as 55%. So it's a steep tax rate, and we want to make sure that we are planning for any potential transfer tax liability that may come upon death. So,
Amy, are there ways to combat this estate tax?
Oh, I'm so glad you asked.
Great segue.
Thank you. That was planned.
Yes, that was great. So yes, Ben, there are 4 weapons that we have to combat the transfer tax system. So I'll go through each of these. So the first tool that we have is something called the annual exclusion gift. Okay, this is the idea that you can give $15,000 to as many people as you want each year. Okay, $30,000 if you're married. So, and there's no transfer tax there. So for all my Aggies on the call, I could go to Kyle Field and I could throw $15,000 at every single person in the stadium, and there's no transfer tax consequence to me. Okay. And there's no income tax consequence to the person who's receiving that wealth. Now, realistically, what does this look like? This looks like, parents giving, husband giving $15,000, wife giving $15,000 to each of their children and grandchildren. So that's typically how we see our annual exclusion gifts used. And, that can be a very effective way to shift wealth outside of the transfer tax system. The next weapon that we have is something called the unlimited marital deduction. So even though we live in this world with a transfer tax system, the government does let you benefit your spouse, leave as much money to your spouse as you would like to, and you get a deduction from any estate taxes for that. So we use this to defer estate taxes. So Brian, when's the best time to pay taxes? What would you say?
Well, I would say never.
That's good. That's right. And what do you think? When's the second best time to pay taxes?
I guess as late as possible.
Yes, bingo. So the unlimited marital deduction allows us to defer any estate tax liability until the death of the second spouse. So the IRS looks at married couples like one economic unit, right? That's why spouses can file joint income tax returns. It doesn't matter who makes the money. So think about it, it makes sense. So weapon number 2 is the unlimited marital deduction. Weapon number 3 is the gift and estate tax exemption amount. So even though we live in a country with a transfer tax, you are allowed to pass a certain amount free of the transfer tax. And right now it's incredibly high. It's higher than it's ever been in our history as a country. It's $11.7 million per person. Okay. So that means for me as an individual, anything over $11.7 million, that's when the 40% tax kicks in on that overage. Okay. For a married couple, 23.4 million before we're worried about that 40% tax. Okay. So the way this looks, you can use this during lifetime or at death. So let's say that I'm feeling really generous and I want to make a gift to Ben. And I say, hey, Ben, I'm going to give you $1,015,000 tomorrow.
Thank you.
You're welcome.
Thank you.
You're very welcome. I wish I had that money to give you. So the first 15,000 falls under weapon number 1, right? Annual exclusion gift, transfer tax neutral, nothing to see there. So first 15,000 off the table. The next million is going to use up a part of my exemption. So now if I die the next day after I make this gift to Ben, instead of having an $11.7 million exemption, I now have a $10.7 million exemption. So this exemption amount can be used during lifetime or at death. And what we're seeing is many clients are using that exemption during lifetime while it is as high as it is. And we're going to talk a little bit more about that. And then this last tool is something called the generation skipping transfer tax exemption. So the GST tax, as we call it, that's imposed to ensure that taxes are paid at every generational level and not avoided through the use of trust. So even though we have this other transfer tax out there, this exemption is saving your children on estate taxes. What we're doing is we're earmarking funds to be free of this GST tax. So what you'll see when we're going through our planning with clients, we always come back to the 3 questions we talked about. Where's your stuff go? Who's in charge? What are the rules? Clients are fired up about making sure the IRS doesn't get as much of their, hard-earned wealth. And so how do we do that? How do we combat that? With these 4 tools.
Yeah. So I think this last point is one that's often confused and misunderstood. And it sounds like, oh, I got to skip my kids and give my money to the grandchildren. And it's really just about, if we're going to go through the process of battling the transfer tax system, we should do it once. We should be really smart. And the name is misworded, right? It's about skipping the tax at each generation. It's not, generation skipping sounds like you have to skip your kids and give it to your grandkids. I just want to skip the tax at the next generation's level.
Bingo.
And when you kind of reverse and change around and unscramble the phrase, it starts to be a little clearer, which is, hey, let's be really smart. Let's do this one time only. So that if it grows from 11 million to 11 billion, well, that's the rules. and I can give 11 billion to my grandkids, great grandkids, no matter what it grows to. So this is an often misunderstood and underused tool in estate plans that has dramatic impacts on families and their ability to pass their wealth through the generations.
Yeah, definitely agree. So next slide, like it says, it's temporary, right? These incredibly high exemption amounts, it's temporary. We know today, the way the law reads today is this exemption is going to decrease 5 million per person indexed to inflation as of December 31st, 2025. So we know for certain it's going to be reduced. I shouldn't say for certain, but that's what the law reads today. But there was an election last November, and elections have consequences. And yeah, so it could be sooner. The changes could come sooner. As everyone on this call is very well aware, there is now Democratic control of the House of Representatives, the Senate, and the presidency. And, there's already been talk of, what changes are coming to not just the transfer tax system, but the income tax system, like Brian talked about last time.
Yes, I mean, we walked through a lot of those proposed changes, and that's all they are right now, proposed changes. And we're going on, what Biden ran his candidacy on. And so if some of those things were to come to fruition, not only could we see the exemption dropped down sooner, but it could be dropped down even farther, right? So one of the numbers that we talked about last month was 3.5 million. That's actually written in the Biden proposal as what he wants the state tax exemption to drop back down to. And so again, there's a lot of unknowns out there. We keyed in on flexibility. We don't want to make all of our estate planning decisions on a permanent basis when legislation is going to constantly change. But to your point, there is Democratic control. We are leaning towards the potential for having that exemption reduced. And the budget reconciliation process that we walked through last time is something that they'll be able to use to impart these changes without necessarily having to have a whole lot of resistance from the opposing party. And so just something to keep in mind.
And they won't have a sunset limit, right? So the Democrats are raising revenue, not decreasing revenue. They may be spending, but they're increasing revenue. So that Byrd rule in the Senate that limits the reconciliation process is off the table for them. Yep. So you saw the Bush tax cuts a 10-year sunset. You saw the Trump tax cuts a 10-year sunset. The Democrats, and again, this isn't political commentary, this is just the rules, aren't going to have the same handcuffs that the Republicans have typically had when they're trying to reduce taxes.
Exactly.
And, flexibility is there, and that 3.5 is an index to inflation.
Yep. And
look, in 2019, I think 6,000 families paid a state tax. It raised $17 billion. $17 billion is 0.5% of the total revenue generated by the IRS. 255 families paid half of that estate tax. Of the 6,000 families that owe tax, 255 families. So if you can imagine, the public demand isn't going to be all that against increasing these estate taxes. They're just not, because it just doesn't affect people.
Yeah. And I've heard some other commentary. Typically, lawmakers will want to go the easiest path to make change. And so one really easy thing they could do is just change the date of the sunset and say, okay, instead of it sunsetting in 2026, it sunsets in 2022. So those are things that they could consider.
And dead people don't make political contributions. So going after dead people is a little easier than going after income taxes.
Exactly.
So Amy, we're in this place where, uncertainty in what's going to happen in DC. We have this 11.7, which in my career is the highest. It started at 675,000 when I started my career. Tax rates were 55%. I saw it creep up to 5 million in 2012, with it dropping at midnight on the East Coast to $1 million with a 55% tax rate, to have, an hour after midnight, them change the law. So everything I did in 2011, 12 wiped out, right? But it ended up being good planning for our families. What's your perfect estate planning, right? We have some of these things we've talked about. What are some of the other things that are in the environment today that we as technicians geek out a little on?
Yeah, no, I'm so glad you asked, Ben, because I made a list. so we can talk through that.
Wonderful.
So anyway, even though this last year has been crazy and uncharted, there is a silver lining for us estate planners, right, that we can geek out on. And it's funny because we used to talk about the time period that we were in with those $5 million exemptions. We would say, oh man, this is the golden age of estate planning. But now the way things are, it's more like the platinum age of estate planning. I mean, it everything that I could want as an estate planner is at our fingertips, and we're using it every day. So first one, in my perfect world, I would have historically high gift, estate, and GST tax exemptions. I mean, like Ben said, it's never been higher. When he started his practice, the exemption was $675,000. It's $11.7 million per person. I mean, that's huge. 23.4 million for a married couple. So can't say enough good things about, hey, we've got this incredible exemption. Let's take advantage of that. Now, if I can give away more than I ever could before, I would love to be able to have a low valuation, to say, maybe we're doing these transactions when there's decompressed values. And, COVID ravaged the nation, right? We've got 2020. Think about the different industries that were harmed. Hospitality, restaurants, sports teams, car dealerships. You can even go into a car dealership and purchase a car for a while. So there are all these, we've got clients that say, yeah, business is bad. And we respond with, sure, but if you have these decompressed values, let's take advantage of that. So low valuations is a huge, huge thing that we're able to take advantage of right now. Now, if I could transfer more than I ever could before, and I can argue that it's, worth lower because business isn't great, where am I going to put that? Well, I want to put it in a dynasty trust, right? A dynasty trust is one that lasts forever. Okay. There are certain jurisdictions where you are allowed to put assets in a trust and it can continue on and have these dynastic trusts. So again, let's take advantage of that. Let's try to leverage that and work in jurisdictions where we can have trusts that last forever. Now, next, discounts are still widely accepted. So I want to be able to say that what I am transferring is worth less. That's all discounting is. I'm arguing to the IRS, hey, this really isn't worth as much as you think it is. I'm entitled to these discounts. So what does that look like? That looks like non-voting interest in an LLC. You're going to get a discount because you have no control. So lack of control discounts. It also looks like limited partnership interest in a family limited partnership. Okay. Well, you're entitled to a discount there for lack of marketability. There's not an open market where I can go and I can say, hey, I've got a, 25% limited partnership interest. Who wants to buy it? So you get discounts, and we're arguing that what we're transferring is worth less than it actually is. And these, again, still widely accepted. We have worked on files where we've gotten as close to 40% discount on fair market value. So this is a very powerful planning technique.
Amy, I'll just add in right there. I mean, so what we talked about, the exemption on the table today gives us a $23.4 million hole if you're a married couple, that we can get stuff through the estate without having any transfer tax. So we want all your stuff to be worth as little as it can be to get it through that hole without having to pay that transfer tax. So those discounts are a huge factor in that.
You take 30 million and you squeeze it to 23, you squeeze it through that $23 million hole, you let that pop happen. So you're hurt, and this is going to go to this point right here. It changes the hurdle rate you have to clear. So Amy.
Right.
Yeah, no, definitely. Ben, you're exactly right. So, we are living in a time where we have historically low AFR rates. So you'll see here the March 2021 AFR rates for 3 years or less. We're looking at 0.11, midterm 0.62, long-term 1.62. So it's 3 years or less, 9 years or less, and then longer than 9 years. That's the order that it follows. So again, this is a very low hurdle. So if I make a loan, a 9-year loan to someone, family member, and I have to charge them 0.62. I have to charge them 62 basis points. So as long as they clear that hurdle of 62 basis points with whatever they're doing with that money, it's a win. right? It's a win. So we take advantage of these and in different ways, whether it's refinancing notes or, selling assets to irrevocable trust, which we'll talk a little bit about in a bit. So the next thing that we really like to use are IDITs. So IDITs stands for intentionally defective irrevocable trust. Now, estate planners really, really like acronyms, but this one is very handy. So what this is you have the ability to create an irrevocable trust. And when you create that irrevocable trust, you can say, okay, this is not me for estate tax purposes. I don't own this. This is not mine, but it is me for income tax purposes. So, and that's very, very powerful. So why do people do this? So people do this because when I am making a gift, it's out of my estate. This is no longer mine, but I own it for income tax purposes. Well, why does that matter? Because when I pay income tax on these assets over here that are in the trust, I am shrinking my estate, and that's not a gift. So I'm benefiting this trust over here, but it's not a gift, which is really, really cool. So think about it this way. If Ben was feeling very generous and he said, hey, Amy, I want to pay your income taxes this year, which would be great, Ben. You should think about that. So
Duly noted. Duly noted.
if Ben says, I want to pay Amy's income taxes, I would say, awesome, let's do it. And Ben would pay my taxes. That's a gift, right? He's going to have to report that to the IRS. It's going to use some of his exemption. But let's say that Ben was feeling really generous and he created a trust and he put some assets in those trusts for me and he paid income taxes on those assets. That's not a gift for paying those income taxes. So that income tax burn that we're able to further reduce a taxable estate and not use exemption, it's incredibly powerful. So we use this quite a bit. And the other, real benefit, you'll see a reference to sales to IDIT. So, let's say that you have, a very, very large estate, well over the 23.4 million. And, we say, okay, what can we do? I still have a tax problem. One of the things that we do all day is sell assets to these trusts in exchange for a promissory note, right? So this ties back into the historically low AFR rates. If I am selling an asset to an irrevocable trust, one, if it's structured as an intentionally defective trust, meaning not me for estate tax purposes, is me for income tax purposes. What we've done there is when we sell an asset from ourselves to this trust, it's an income tax neutral event. There's no capital gains because I am selling an asset from my left hand to my right hand. Okay, so we're shifting that wealth outside of your estate. And then what we've done is we're shifting that growth on the asset in a vehicle that is not you for estate tax purposes. Okay, and that's very, very powerful because again, look at the low hurdles that we have to beat. So long as our investment beats those hurdles, it's a winner.
Yeah, I mean, I think the best way to think about that is if you have a partner in the IRS with a 40% estate tax, what can we do to grow your wealth so you don't have to pay those dollars in the future? So we have this schizophrenia that exists in the tax code today between the income tax and the estate tax. We take advantage of that. We create trust. We let this growth happen. We have low hurdle rates. We have ways to squeeze more through that $23.4 million hole than we've ever had before. We have this ability, if we have a net worth in excess of that, to get it in there at these low hurdle rates, these low interest rates for long periods of time. And we have this tax favored status where we can keep bankrupting you from a pure transfer tax perspective, over the time, which these are the three key goals of how you bankrupt wealthy families to minimize estate taxes. My goal when I meet families is to bankrupt them purely from a transfer tax perspective. And we've never had it better.
Yes, it's that platinum age. It
is platinum.
A lot of good things out there right now. You combine them all, we got a pretty good setup for sure.
Definitely. And the last thing on my list is the life insurance tax favored status. I mean, it doesn't get much better than this. So we've got tax-free growth of the cash surrender value. The death benefit is income tax free. And if it's structured properly, the death benefit can escape estate taxes as well. So yes, it's been a rough year, but from my estate planning geek inside, it's been great because we've got all these opportunities.
And I think, you know, the key here is sometimes you don't know how good you have it when you have it. You don't realize how favorable the environment is until it's gone. Because if I look at this list, Obama, again, this isn't political commentary. This is just what he did for the last 5 years of his presidency. Every year they issue the Green Book, which is the president's perfect world budget. Low valuations, wanted, you know, our dynasty trust, wanted to get rid of them, wanted to limit them. Discounts, wanted to get rid of them. IDIT formations and sales to grantor trust, wanted to get rid of them, right? So he historically high gift exemptions, wanted to go back to lower amounts, wanted to raise the tax. Everything on this list was under attack. And that's when in the last 5 years of his presidency, when he was facing a Republican Congress, both in the House and the Senate. Right now you have a Joe Biden Democrat with a Democratic House and Democratic Senate. They don't have to deal with the, you know, 2008 economic recession. Yes, they had COVID, but they dealt with that by just passing 1.9 trillion of stimulus. They're talking about another 3 trillion of stimulus, right? They're keeping that economy bolstered. So when they get to the fall reconciliation bill, I wouldn't be surprised if some of these things are low-hanging fruit that people don't know about. Dynasty trust, Brian, to your point, low-hanging fruit. No one thinks about that, right? Except guys like us and Amy. You know, we're all geeking out on this stuff. Discounts, no one's thinking about that except us. Yeah. Grantor trust, no one's thinking about that but us planners. So that's going to be easy stuff for them to just.
Exactly. And from an optics perspective, it's a more widely accepted, you know, optical change, right? So these are things that are typical to go away when you have, you know, that uniformity within control. So,
you know, life insurance was designed for the orphans of the, you know, firefighters and the soldiers. That's why it's got tax favored status, and it just, the lobby is really good. But yep. I got billionaires who figured out, wait, I can buy this asset and, you know, my rate of return is X and I don't have to pay income tax on it.
Yeah.
I'll buy as much as I can buy, right? I mean, they've figured out, I mean, they're big industries that are buying life insurance because of tax favor. So it's, don't be surprised if they go after these things in the fall.
Yep.
And absolutely, you don't know until it's too late. So Amy, you know, we've talked a lot about some of the techniques and the what we're, you know, the what and the tools in the toolbox. Kind of what are we doing right now? I mean, I know what I'm doing. I'd like to hear from you, what you're doing. Brian, I'd love to hear from you. Kind of what are you guys doing with your clients? What are you telling them? How are you engaging them? What are you seeing that people are concerned about?
Yeah, I mean, I'll kick that off. So, I mean, it's the first thing that I would say is let's look at what's already been done. Right. And so, Amy, I know you and I have worked on a lot of families together, and that's really where we start, right?
Yep, definitely. We always want to take a look at their existing plan and, you know, answer those 3 questions. Where does your stuff go? Who is in charge? And what are the rules? It's amazing to me how many people don't, you know the answer to those questions. And so, you know, we want to take a look and see, hey, do these things still apply? Do we still have the right people in charge? Do you want to, you know, change anything? And so we always want to start with where your stuff goes, who is in charge, and what are the rules. And so when we're doing that review, we're looking for a couple different things. So one, we're looking at outright distributions. We like trust, right? We want those assets to be put in a trust for your beneficiaries because the benefits are so great. Just escaping the transfer tax system, creditor protection, divorce protection. The other thing we see a lot when we review current estate plans are tiered distribution. So, you know, for years, many practitioners were doing, okay, trust distribution at 25, 30, and 35. And then the trust goes away once the child reaches age 35. We say, no, keep it in trust for their lifetime. Keep it in a lifetime trust. We'll look at distribution standards. Like we said, do we want absolute discretion? Do we want health, education, maintenance, and support? One big area to review are formula clauses. So if your estate plan is tied to some sort of formula, let's say it's tied to the exemption amount. Well, you've changed your estate plan since you've signed it, and you don't realize that. But if you have your estate plan in a formula that's tied to the exemption, that exemption changes. And so you've changed your estate plan, even if you don't know it. Okay, so those are things.
Great example there is you have a blended family.
Mhm.
New wife, children from old marriage, new husband, children from old marriage. And what you leave your children is tied to the exemption amount. And spouse gets the balance because of that marital deduction, right? Using weapon 3, using weapon 2. And as that exemption goes up, your children get more and more, your spouse gets a lot less. Surprise, nothing left for the spouse if you're not paying attention, if you're not watching it, and vice versa.
Yeah.
So, I mean, you can be caught off guard if you're not paying attention, you're not reviewing, you're not even looking at your existing plan. Again, back to that journey versus destination, this formula clause is really important. A lot of people did planning in 11 and 12 or 10 that had formulas based on if there's an estate tax, if there's not an estate tax.
Right.
And never looked at it because the attorney put in some technical provision that doesn't apply anymore.
That's exactly right. And, I always tell clients, hey, we need to have, hopefully we're going to have an ongoing relationship. This is an ongoing dialogue, which every single time we'll visit, I'm going to say, where's your stuff go? Who's in charge? What are the rules? Right. And so we're always constantly reviewing these things. We're looking at our trustee selection. Does it still make sense? Do you still have people appointed who you want appointed, or has the person you appointed passed away? I mean, these are things that require attention. And then flexibility. We've talked about that before, where we want these documents to work for you and your family. Changes in the tax law, changes in family circumstances. Let's make sure we've built in that flexibility through, trustee appointments, trust protectors, and powers of appointment. And then finally, many clients, we've got all kinds of people moving to Texas right now, right? They may have estate planning documents that work in, California or New York, but maybe they don't work as well in Texas. So these are things that you always start with reviewing your current documents.
Yep.
Mm-hmm. So, and once we've reviewed those documents, we typically take a 4-step approach. First step is, do we need to update your core estate planning documents? So your core docs, this is no matter your net worth, no matter if it's 200,000 or 2 billion, you always start with your core docs. And this looks like a revocable trust. We're going to have a pour over will, and powers of attorney. So for financial decisions and healthcare decisions. Once we've got your core docs in place, then we move to discounting the estate, right? That's that part where we're trying to squeeze $30 million through a $23.4 million hole. We're trying to say, hey, can we argue that what you own is worth less? And the way we do that is recapitalizing corporations into voting and non-voting stock. Maybe we're going to form a family limited partnership or an LLC with voting and non-voting membership interest, or maybe we're going to fractionalize real estate. And so those are all the different ways that we look at what you have and say, hey, how can we argue that what you have is worth less? Once we've looked at discounting, then we look at moving assets into those vehicles that are outside of your estate for estate tax purposes. So we're going to, create those intentionally defective irrevocable trusts that are not you for estate tax purposes. They are you for income tax purposes. And we're going to move wealth. We're going to move wealth through gifts and sales to these irrevocable trust that we've created. And then finally, once that is in place, then we'll look at charitable planning. Do we need, do we want to have a private foundation, a donor advised fund, things like that? So this is typically the approach that we take. Always start with reviewing your core docs, see what you've got in place, and just go from there.
So the key is simplify, right? So let's look at what you got. Let's make it worth less. Let's move it out of your estate. And then let's give what we want to charity.
Yeah. I mean, if there's a sequence to it, there's a process, 3 questions, 3 places it goes, 4 weapons, 4 steps, right there. This is a very linear process. It is also not linear at the exact same time, but there's a playbook for how you build an estate plan to achieve your goals. And oh God, simplifying is one of my favorites, right? It makes everyone like their plan, because if I can create the best estate plan, but if you won't respect it and it's too complicated, you won't do it. You won't do the things that we need to do. So there's that practical meets technical. And that's what the simplify concept is really about, is how do we simplify those estate plans? And one of the very first things you hear us, and we keep coming back to it, is it's a journey. It's not a destination. How often do the 3 of us come across families where we're just starting and they've had multiple advisors, multiple planning, multiple years, sometimes even with the same exact attorney, and you read their documents and trust A says X, trust Y says, trust 2 says Y, and trust 3 says Z, and they don't coordinate, they don't consolidate. Plans have gotten out of date, things are unwieldy, promissory notes aren't managed, it becomes too much, so we simplify. Oftentimes we'll come across families that are loaning money to their children. Amy, you hit the nail on the head. I can loan my kids $1 million. They can buy a house. The interest rate 62 basis points or $6,200 a year. They can get into a house for, God, my math's not that good. Is that $500 a month? Right? I mean, that's not bad for $1 million house.
Right.
I've helped my family out, but maybe I don't need that $1 million. Maybe it's, my exemptions have gone up and I can forgive it and I can just let my kids have the house. Sometimes I meet families that were doing family limited partnerships for that discounting concept you talked about back in the early 2000s when their net worth was $5 million and the exemption was 600,000, or they are doctors in practice that don't need the asset protection anymore, but they're still out there. We're still spending the money to administer these things that have zero value to their life. Let's shut them down. Let's get rid of them. Let's simplify. Let's make your life easier. And then the other thing is, if the laws are really going to change, let's get monies in these trusts, whether it's to fund life insurance, because I know there's an ongoing, need for that insurance and there's an ongoing premium requirement, or I just want to take advantage of these exemptions that could be going away. And don't be surprised when they do. I want to make sure that I'm pre-funding these insurance trusts so that I can, again, not have to send out those crummy notices, not have to tell my beneficiaries I've put the $15,000 in the trust, I need just sign this piece of paper, and I'm getting angry because you'll be happy to spend the money in the front end, but when I send you a bill for $100 to send a crummy notice out, you get angry with me. And I get it. It's annoying, but that's part of the game, right? So let's simplify.
Yeah, no, I totally agree. And I'll just add, one of my favorite things to do for a client, is show them their estate plan on a single page. Just show them on a single page how everything flows in a flow chart. It's rewarding for me personally when they get it, when it's like the light bulb goes off and they say, okay, I see where things are going.
Yeah.
And especially when you put on a screen, hey, here's what's going to family, here's what's going to charity, here's what's going to IRS. I mean, their eyes will just light up. And so, yes, I totally agree with Ben and Brian. Let's simplify. Let's make it easy to understand, so estate planning is not so overwhelming, because I think part of the problem is, people get overwhelmed by it, so they just don't think about it. They just push it aside.
And Amy, I can testify to that, because in the very beginning with a client or a family, like, man, this is so complicated. I don't understand any of it. I don't know the difference between a revocable, irrevocable trust, where all this stuff is going. You guys come in, give us that 1-page overview, and light bulbs go on, and it just clicks.
Yeah.
I think that's right. If I can't show you what your plan does on a single page, I can't tell you in 3 lines where your stuff goes, don't hire me. I've made it too complicated.
No, I agree.
So
we are running a little short on time, so we're going to jump past this. We have kind of touched on how to use it, right? Making gifts, making loans to intentionally defective trusts, who they're for. We want to cover a specific case study that might be really applicable to some of the folks on the call. So you guys want to jump through that?
Yeah, so let's kind of jump into kind of tying all these concepts into a case study where you can see it actual in practice. So his and her IDITs is simply how we do irrevocable trust planning for a married couple, right? Husband sets up a trust for wife, husband sets up a trust for wife, wife sets up a trust for husband. So let's kind of jump into a facts here on a case study. So common example is we have a couple early to mid 50s. In this one, husband happens to be 55, wife happens to be 51. They have 2 daughters, age 24 and 22, right? And oftentimes we'll meet with folks and we're just picking a net worth of $50 million. And it's really kind of an average portfolio of cash, marketable securities, rental properties, and other closely held business interests. And when we met them, they had existing core documents, but those existing core documents had those outright distributions, right? Give a third at 25, a third at 30, a third at 35. Now, I've been 25, I've been 30, I've been 35. I was a lot smarter at 35 than I was at 25. But if someone had given me, 1/3 of 1/2 of $50 million, or roughly $8 million at 25, even though I had a wife, and even though I had a house, and even though I had two kids, and I had a washer and dryer, and I was really mature for a 25-year-old, the life decisions I would have made at 25 with $8 million being handed to me would have been drastically different. And I would have made very different decisions. So you can have very mature 25-year-olds, but they don't have perspective that we've all gained as we've climbed the mountain, as we've gone through life. Because I look at myself and I'm just like, I was just a dumb 25-year-old, So what was the concerns of the family, right? So they wanted to retain control in a shocking development. Mom and dad wanted to take control. They wanted to take advantage of those low valuations, right? You're in an environment where COVID has hit. We don't know exactly what's happening, but people aren't coming to the businesses. So we wanted to move the rental real estate. We wanted to move the closely held businesses. Shockingly, they didn't want to make their children wealthy at 24 and 22. They were still fairly young at 51 and 55. So they wanted to access the business wealth. They understood they were still facing an estate tax problem. So at 50 million, you could pass 23, that's 27, subject to a 40% rate. That's roughly $10 million in tax that's still owed if they died that day. So what did we do? Well, in a shocking development, we walked them through the process, right? We said, let's get those core documents updated. And more importantly, let's update those core documents with those generation skipping trusts. Let's make sure that of what we leave your children, we do it in lifetime trust for creditor protection, divorce protection. One of your children statistically is going to get divorced. Let's not have a discussion of whether it's community property or separate property. Not my property. Let's update those wills. Let's get those financial power of attorneys. They had a dead brother named as an agent. Well, that's no good. That's not going to do you any good. And, parents were now, they're healthcare agents and their parents were in their 80s. That doesn't make any sense. So let's really get those core documents updated so the base of the plan was solid. So then where we went was we wanted to create that holdco with voting and non-voting interest. Why? Discounting, right? I really wanted to create a vehicle that, one, they had control. Remember, one of their goals was control. So if I create voting shares and I create non-voting shares, I create that control. And by the way, as a byproduct of that, of creating voting and non-voting shares, by creating in a vehicle that maybe gets me enhanced creditor protection, because when we go to law school, Amy, do they tell us to sue Mr. Empty Pockets or Mr. Deep Pockets? The example is always deep pockets, not empty pockets. So we wanted that asset protection. We wanted family harmony. The girls were starting to come into the business. So we created this entity that got us discounts, and we put about half their net worth in that estate. So pigs get fat, hogs get slaughtered. So we always look around and say, what's the most reasonable amount that we can put in these vehicles to retain this control and probably get some discounting. So then in a shocking development, husband created trust for wife. Wife created trust for husband. We put assets in those. We took advantage of that 11.7 because they're 50. At 7%, we have a doubling every 10 years. They live 30 years, and I think that's short. If you look at the actuarial tables, they probably go into their late 80s, early 90s if they're healthy, because when you're worth 50 million, you can afford the best health care. 50 becomes 100, 100 becomes 200, 200 becomes 400. The estate tax on their growth is bigger than their net worth today. So we said we should move that growth into these irrevocable trusts for the husband and the wife. Now, there's some risks. You got to make these trusts different. The IRS gets a little cranky if you try to do this and make these trusts exactly the same. So you got different trustees, different beneficiaries, and we that's why you hire us to tell you how to make them different. And finally, we were concerned that if we did this on Monday and someone died on Tuesday, the surviving spouse loses access to some of that money in the trust for the deceased spouse. Yes, it's for the kids, and yes, they financially probably can afford not to. But, I skipped a step. This was just the gift of cash and the non-voting interest, and then we purchased life insurance. So we got those gifts in there, we sold the assets, and then we insured each of them, to make sure that they had access to this wealth, because we want them to have access to all the money during their lifetime. Yep. So we walked them through the exact same process that we always do. So Amy, I don't know if you want to kind of jump in here and talk about the motivations and what really made these guys excited about what we did.
Sure, absolutely. So big thing was using that exemption before the assets grow. And while it was as high as it is, right? So we were able to shift the 23.4 million in a vehicle that's outside of their estate. We're able to keep the business for the client and the family. We shifted that appreciation on the assets, and we provided liquidity with that life insurance to ensure the business has capital to continue. And like you were saying, if we do this on a Tuesday, spouse dies on a Wednesday, we've got an influx of cash in one of those trusts for the surviving spouse. And then, finally, with the retaining access to business wealth, we had the his and her IDITs, right? We didn't give it to the children right away. We maintained control with that voting control. And so, yeah, it was a success for the family, definitely.
So we've got a couple of other things that and we're actually going to post a copy of these slides on on our website. Because of time, we want to be respectful. We're running up against the end of the hour, so we're going to go down and just kind of wrap things up for you guys. Big takeaway on this call is we've got an awesome environment that we live in today. We've got a lot of really cool tools that we can use to help reduce the size of folks' estates. But the big takeaway is, we've been talking about what and how for the last hour, basically, right? But when it ultimately boils down to it, we got to get down to why. And why do we even take the time to do these things? What are we really trying to accomplish? And Ben, you want to just kind of wrap us up around that concept of, we've talked about what, we've talked about how, but really getting focused on our why and why we enjoy working together so much.
I think it's a great point, and it goes back to your mission statement: help families. It was the very first thing you said. We're in the business of helping families. It's what Amy and I do, is we help families. And at the end of the day, the 40% estate tax, I'm not scared of it. If I can't save it, I can't avoid it, I can't mitigate it, don't hire me. What's a much more troubling statistic is 90 to 93% of families are shirt sleeve to shirt sleeves in 3 generations. Generation 1 creates it, generation 2 protects it, generation 3 spends it. What often happens is, if we want to go to the next slide, is we always focus on passing dollars. We always talk about starting with passing dollars. That's how I add my value, right? That's my V. That's how I get you engaged. But what's more important is actually passing your values. It happens to be another V, but how do you instill in your children what is the wealth for, right? And that's really, for me, a much more meaningful, real conversation. Whether it starts with, hey kids, I want you to help me figure out where I'm going to give $10,000 to charity this year, to, hey, think about all the jobs we create for the families we support. We employ 1,000 people, and look at all the families we've had an impact on. Or, hey, education is the key to mobility and to be in a great society, right? So if we can't help you identify what those values are for, and with Brian's help and the entire team at Granite Harbor, communicating that to the children, communicating that to the grandchildren, and doing it in a way that makes sense and is consistent, we are failing you, right? You will fail your family. I don't care how much wealth you leave them. If you don't consistently communicate what it's for and what the family values are, you're all done. And I think this, I was listening to a podcast, and I actually have this quote literally written 2.5 feet in front of my face on my whiteboard, which is happiness equals reality minus expectations. So we all have this expectation that, wealth will create happiness for our children because they have money, they can buy away their problems, but that often isn't reality. So when those things don't align, what ends up happening is children, grandchildren aren't happy, because we haven't really set expectations from reality, because we aren't communicating. We're scared to tell them about what it's for, what our history is, how we did it, why were we so invested in our business, what we were doing. So I think one of the things I try to keep in mind as I go through this, and Brian, I know you do this, and Amy, I know you do this as well, is reminding our clients happiness is reality minus expectations. So if we set the expectations, we tell them what the rules of engagement are, and we tell them what it's for and how to do it, when that reality happens, everyone's happy. And that 90 versus 40% really becomes a minor issue, because we've combated the 40%. We've set families up to be successful. They're going to be the anomalies. They're going to be the outliers. They're going to be the 10% that gets it right. And that's what keeps us getting up every day. That's what makes us grind through all of this together. Because, you know, first thing I do is I wake up and see what fires I'm putting out in the morning, right? My eyes are barely open. I'm checking the email to say who needs help. And before I'm going to bed, you know, who needs help before I go to sleep? Last chance, who needs help? And this is what we're doing it for, is to get this done.
Well, guys, thank you so much for being on the call. We're right at the top of the hour. We covered a ton of stuff. I know there's going to be a lot of questions around the information that we shared. I know you all probably woke up wanting to talk about death and taxes today, but these are really important concerns. And just remember, get down to the why, get down to what your why is, and we can help you answer the questions around the what and how. And so if you had questions throughout the presentation and how some of these things may specifically apply to you and your family and your family's goals, feel free to reach out to us, and we can help you kind of get those answers done. So again, thank you very much, Ben and Amy. Great as always. We thank you so much for joining us and everybody on the call. So have a great day. Enjoy the rest of your week.
Appreciate it. Thank you.